Foodworks up near 7% on the back of inline second quarter results. The Domino's India owner beats for revenue forecast with a 43% rise. Delivery revenue grows up 15.9%, whereas average daily stores at mature Domino's stores reaches a 6-quarter high.
FMCG giant Britannia slips in trade after posting a decent set of Q2 numbers. The volume growth in line, the revenue grows by around 5.3%, but EBITDA misses estimates due to lower gross margin and higher employee cost.
NMDC falls nearly 3% after a big miss on margins in the second quarter. Gross margins contract due to higher than expected stock adjustment. Board also approves a 2:1 stock bonus.
RateGain falls over 5% a day after hitting a 3-month high on the back of strong Q2 numbers. The company cuts its FY25 revenue growth guidance due to loss of large mid-market hotel chain, weak order booking, as well as pricing pressure in the DAAS segment. Hello and welcome to Chartbusters. I'm Nigel, with me is Mangalam. Well, as we speak, the markets are holding in the green. All the frontline indices, they're trading mostly with some gains. Not decisively breaking out, but some green is what the bulls will take.
Some green is what the bulls would take, most definitely. You know, after failing to hold on to higher levels yesterday, Nigel, will be important to see how that happens. The Nifty is recovering from the lows of the day, though they've seen some sell-off at the highs. I'll be interested to see how the IT pack continues to outperform, because we have Infosys, which has now suddenly moved to the high point of trade. The IT index should come up for you. And alongside that, we have some of the consumer companies which are taking it on the chin, mainly Britannia. We've been hearing in on the conference call, I was just listening into that, and that the management has said the next couple of quarters look a little skittish when it comes to volume growth, because there has been slowdown in urban consumption. So there might be some impact on the volumes in the near term, even as there is inflation in their raw material prices. But IT is doing well. Let's focus on the new kid on the block in that space itself. Healthcare tech solutions company Cility India saw a flattish listing on D Street, which isn't particularly bad given the sort of market that we're in right now. 30.8 rupees per share, currently holding with gains of almost 6% Ramesh Gopalan, who's the Managing Director and Group CEO at Cility, joins in now to explain the company's post-listing strategies. Thanks a lot, Mr. Gopalan, for joining in, and congratulations on the listing. It's a 6% up move that we've seen after a flattish opening. The street now wants you to tell them more about the growth that you're planning in terms of the overall business over the next couple of quarters and the trajectory, if you could give us those numbers now.
First of all, thank you for having me on your show. Yes, it's a very proud moment today on getting listed at the stock exchanges. Yes, Cility is a tech-enabled business services and solutions provider to the US healthcare industry. We serve both payers and providers, and we've been doing this for 24 years now. So we are a well-entrenched player in the US healthcare sector. We've grown our top line in double digits over the last few years, and we are reasonably confident that we'll continue that growth trajectory in the future as well.
Okay, all right. Hi, Mr. Gopalan, and good morning and welcome to the stock markets. The stock is listed with a gain of around 5.5%, in spite of your Q1 being actually a little bit softish. So could you tell us that revenue growth will pick up yet again? You know, in the past quarter, I think it was 10%. On an average, I think you do low teens. So should we work with that sort of a number? And the rough margin band as well?
Yeah, like I said, our top line growth has been reasonably consistent over the last 3-4 years, and we think it will be in the same range for FY25 as well, right? So every quarter there may be a little up and down, but for the year as a whole, we are confident that it will be in the range. And the margins have also been always consistent. So while you might see a lower reported number in Q1, that's because of a one-time adjustment in a specific earn-out expense. If you add that back, our margins are back to the 23 to 25% range, which is the range that we've always been in. And so we are reasonably confident of keeping those margin numbers as well.
All right. So low teens is the revenue growth that you're guiding for, with margins back to normalized levels as well. What kind of investments do you foresee for the company to achieve this sort of low teens growth that you're talking about? Because while you all have listed, the IPO does not bring in some fresh issue or fresh money to the company itself. It has largely been an offer for sale.
That's true. But if you look at our cash flows, we've been generating cash all these years, right? So our free cash flow is in FY24 was 95 million US dollars. So we generate enough cash flow to fund our organic growth. And so we don't really need capital raise for funding our growth. And these growth numbers that I'm telling you are all organic numbers. We will continue to look at M&A as a growth opportunity. And if that happens, again, we have funds to support that growth. But we'll have to see the size of deals that we do. But broadly, we generate enough free cash to fund our organic growth.
Taking that point, in terms of inorganic growth, what's the typical ticket size that you look at? And I think you're looking to, more at the US markets. Everyone says India is the hot market. Then why not India?
You in terms of M&A or in terms of
in terms of M&A,
the target market?
M&A.
Yeah, so in terms of M&A, we are open to any of the markets, right? So our end client market is the US market as of now.
Got it.
So if we find someone catering to that market with capabilities in India, we'd be happy to look at those acquisitions too. But we've done a couple of acquisitions in the last couple of years. And they've been more capability-focused acquisitions. And so those companies could be anywhere.
Right. In terms of ticket, you said that you have the war chest to actually fund growth via M&A opportunities as well, over and above the cash flows that you use to generate organic growth. If you could give us a sense of how big that war chest is, and in terms of end target market as well, you will stay in the US itself?
Yeah, at this point in time, we intend to stay in the U.S. Like I've told you before, U.S. healthcare spending is the largest in the world. It's about $4.7 trillion, larger than the GDP of India, right? So it's a very large market, and it's growing at a healthy pace. And we are still very small in that large market, and the growth for us is very attractive in the U.S. market. So at least for the near future, we will still continue to remain focused in the U.S. Healthcare space. And in terms of the war chest, it depends on the size of the deals that we do, right? So the deals that we have done in the past were sub $30 million, and we funded them organically. But if the deal sizes are larger, then we might look to capital. But at this point in time, we are not sure of what the deal sizes are likely to be in case we pursue fresh M&A opportunities.
Are you in touch with any of the companies right now? Are you pursuing any opportunities that we should hear of in the next, say, 6 to 8 months?
It's very preliminary, right? So we have a in-house M&A team who is constantly looking at opportunities. But right now we don't have anything firmed up yet. So it's very preliminary.
Okay, all right. Your ICRA rating is BBB stable. I think A3 plus. Could you tell us, is there a possibility that you get a rating upgrade from ICRA?
See, the debt that was raised to fund the carve-out transaction from HGS was funded by both equity and debt, right? So, and some of the rating is based on the debt on the parent's balance sheet and not ours. And yes, with some of this restructuring, the rating could improve in the future.
Final question then before we let you go. You did allude to the size of spending in the US healthcare market itself. In terms of your total addressable market in the US with the capabilities that you have, what is that number, if you could give us a sense? And at what rate is that industry growing?
Yes.
What's the market share that you have out here?
So what we do for our clients is the core operational work, right? So the operations spend across payers and providers put together was about $200 billion in CY23. And that is projected to grow to $258 billion in the next 5 years. And so if you look at the growth in the core operations spend as well as the outsourcing propensity of clients increasing, the two put together, industry analysts estimate a 8 to 9% growth in the addressable market for us.
All right. And you don't get impacted by Gen AI?
Yes, Gen AI is likely to impact every industry. And today, we have acquired a company with capabilities in Gen AI. And today we have a number of use cases using Gen AI that we are piloting for all of our clients. And Gen AI is an efficiency tool for us. So we are likely to use GenAI in a lot of our operations to generate efficiencies, and we will pass back a large part of those efficiencies to our clients and also keep some for ourselves.
I was hoping that clients would come to you for those Gen AI capabilities and not bypass you and do it themselves. And you said that you will pass it on to them. We'll talk about the larger impact of that on another day. Today is a day to celebrate your listing and the near-term outlook that you've given. Low-teen sort of revenue growth will continue with the margins adjusted for one-offs will go back to normalized levels. You're looking at capabilities and do not wish to move away from the US market for now, given its attractiveness. With that, we'll shift focus to our special segment. We get you a few ideas of profit coming in from our colleagues at Money Control Pro. Bharat Jinani joins in with the stock that he's been tracking.
Today's highlights will be Metro Brands Limited. Growth continued to remain under pressure, with the company posting mid-single-digit growth in Q2. EBITDA margins declined marginally, owing to liquidation of old inventory and subdued growth. While the growth has been under pressure, we expect a strong improvement from the second half, owing to the upcoming wedding and the festive season. Also, low base in the corresponding period last year will aid in overall growth. The company has witnessed strong growth in the month of October and has broadly retained its FY25 growth guidance of 10 to 15%. The company is aggressively expanding new stores and aims to open about 100 new stores across formats in the current fiscal. The company opened first Foot Locker store in India in the market of Delhi, with differentiated product offerings in footwear as well as apparel in the sports and the leisure segment. Foot Locker has a strong growth potential. The company has almost entirely liquidated the old inventory at Fila. Fila is in the process of shifting its production to India to meet the BIS regulations. Once the supply chain issues are sorted, we expect ramp-up of the new store openings in Fila. Fila has a long-term growth potential for the Indian market. The stock has underperformed, correcting about 15% in the past 3 months. At the current
Okay, all right. We got a broad idea on that. Thanks a lot for that, Bharat. Well, for the time being, we'll slip into a short break. On the other side, we'll get chatting with Amit Mahavar from UBS Securities to discuss the future of the consumer durables, infrastructure, and industrial space. You don't want to miss this conversation. Stay with us.
Welcome back. You're watching us here on Chartbusters. Let's get in an interesting conversation now. India's industrials and consumer durables space. The inflation is weighing in on entry-level consumer players, the durables players that is. To discuss this and much more, we are joined by Amit Mahavar, who's the consumer durables and infrastructure as well as industrials analyst at UBS Securities. He joins us from the sidelines of the UBS India Summit. Thanks a lot, Amit, for joining in. A pleasure speaking with you. Speaking about the consumer durables space itself, everyone's talking about inflation and its impact on consumer sentiment on the whole. I just wanted your thoughts on what have you made of the results so far? What are your expectations from the companies that are yet to report? And in light of that, what would be the best opportunity from a investment bet in the space right now?
Thank you, Nigel and Mangalam. Good morning. Thank you for having me on the show. So I think industrials for last around 2 years plus has been suffering from the inflation bit. The consumer durable companies are not able to pass on the inflation impact, right? And that's reflecting in the inferior profit growth, right, for last couple of quarters. But we are of the view that some of the emerging themes here, like electrification, where you see very strong growth on cable and wire space, right? The real estate and the general white goods growth has been picking up gradually. The cooling space in last season was very strong. So we believe in the next 12 to 24 months, consumer durable normalization of demand will happen, and you will have profitability ramp up which will start, which was missing for the last 2 years. That is our broad directional view on the consumer electrical durable space.
All right, hi Amit, morning, and good to see you, Ben. So you're not really perturbed with the near-term slowdown that we could be experiencing?
So what you are seeing is around the current festive, if you look at the commentary of most of the companies around H1 results, broadly they've been able to stock reasonably okay, like the room AC segment has surprisingly seen a very strong stocking, right? Fan after BLDC transition has gradually picked up, but I cannot say that the demand is still very strong. So we are actually heading for a very gradual normalization of consumer demand. Entry level, yes, generally has struggled. Even on the urban side, you've seen a lot of brands are not able to pass on the pricing. So if you expect in a very near term any strong growth, that is unlikely and difficult. But I think on a 12 months to 24 months period, I can say that the earning growth in consumer durable names should be better than the last 2 years, for sure.
Yeah, so let's get a little more specific now, Amit. You said the cooling space is looking good in particular, and there would be profit growth over the next 12 to 24 months. If you could give us a sense of what is your expectation of profit growth over the next 12 to 24 months, and what are the companies under your coverage which are likely to outperform the industry expectations here?
Sure. Yeah, I'll maybe disappoint you on the name side. I will not take,
That's okay.
not allowed to take stock-specific names, but directionally, I think refrigerator, room ACs, we expect the profit growth should be in high double digits, more than 15-20% plus, on the base of profits and margins that are actually fairly weak in last 2 years. You saw how room AC companies, air cooler companies, ref companies have reasonably grown on volumes, particularly air cooler and room ACs, but they've struggled on the profitability, right? We think in the next 1 to 2 years, that is where you will see profit rebound and inflation normalization, demand side picking up well, and more importantly, players are ready and the supply chain is stabilizing, which was shifting from China, etc.
What is the updated number on the penetration of room ACs as well as refrigerators here in India? Because as the per capita income moves up, that as well, the penetration is likely to increase. So you could give us an updated number on how do you see that headed?
See, refrigerator is fairly penetrated at more than 30-35% plus. It's a fairly penetrated space. Room ACs is still under-penetrated at less than 10%. Right, if you compare with all the top economies, we are fairly lagging. So that is going to be the main structural demand driver. So that is the reason why you see a lot of global and local companies entering the room AC space.
And washing machine even lower?
Washing machine is even lower than room ACs, yes. All right, we'll wrap it up with a view on wires and cables. If you have a view out there, I mean, we've seen, clear outperformance by one of the players and some sort of expected market share loss for the other incumbent. What are your thoughts here for the next 12 to 24 months?
I think the biggest trend that we've highlighted in our research notes on the cable and wire post our initiation is that the domestic industrial infra and underground cabling story is very strong. And you have a very strong tailwind of global electrification rally where Indian companies are emerging out as big exporters to the Western world, right? You see the top 5 companies in terms of cable exports particularly. We have a big number now, if I'm not wrong, more than $2 billion worth of cable is what we are exporting annually as per the last updated number, and there's a strong headroom to grow. So domestic growth is strong on the volume side. They are fairly reasonably good pricing power, even better than the B2C segments. And to top it up, the demand from export is very strong for last maybe around a couple of quarters.
Okay, all right. Tremendous potential in India, and there's an export opportunity as well. On that optimistic note, we leave it at that. Amit, thanks a lot for joining us and speaking to us on that. Do keep in touch, and we look forward to hearing your views. Well, it's time to slip into a short break. As we do that, here's a programming note. As CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit on November 14th, starting 10 a.m. onwards. A power-packed day with several panelists focusing on India's economy, digital landscape, markets, entertainment, and a lot more, only on CNBC-TV18. Welcome back. Well, keep an eye out on a few stocks. NMDC, we were mentioning earlier today that, the numbers were weak, but the way ahead seems bright because they've already taken a couple of price increases. So the stock opened up with a cut-off around 3%. It's almost moved into the green. Keep an eye out on that one. On the flip side, we have Cummins that's moved to the low point of the day. Godrej Consumer as well has slipped a little bit. So that stock as well has moved a little bit lower. And the other one actually that's doing well is Metropolis. We had the management that joined us yesterday, and they sounded quite optimistic about business going ahead, currently up 2%. NBCC as well has bagged a 450 crore order. So explains why there's a volume and price support on that stock.
Absolutely, Nigel. Just keeping an eye out on Britannia. Remember when we started the show, the stock was down about 2% Conference call commentary wasn't particularly good. They are perturbed about the near-term volumes and also margins for the company as raw material prices increase, and as a result of which the street's taking note of that. The stock's down at the low point of trade with a cut of almost 4.5%. And mind you, this was yesterday as well where we saw a sell-off on the counter. It was down about 5% in yesterday's trading session, topping it up with another 4%. All of this despite an 8% volume growth in the second quarter. Why? Because the near term does not look particularly good from a volume and margin standpoint. We take a short break, come back. On the other side, we have the team of Trading Art taking all the market action forward.